So we are live now. And hello everyone. Good afternoon. It's an exciting day as we kick off another insightful session brought to you by Sagar Smart City Limited and Spark Incubation Center. I am your host Rajnish Dubey representing Spark Incubation Center, and we come with a very interesting topic of weekly online session is how to evaluate the valuation of your startup. So, on today's session, we are going to understand the various aspects of a startup valuation, importance of startup valuation, and what are the methods by which you can evaluate the valuation of your startup. So, for today's session, it is with great pleasure that I welcome you for today's webinar featuring our esteemed mentor, Dr. Kishore Nuthalapati ji. He is the Chief Financial Officer in BEKEM Infra Projects Private Limited, hailing from the vibrant city of Hyderabad. So, on behalf of Sagar Smart City Limited and Spark Incubation Center, we welcome you, sir, for today's session. Welcome, sir. So let me
Thank you.
quickly introduce to our today's speaker, Dr. Kishore. Dr. Kishore is a seasoned corporate financial professional and economist, bringing an extensive 25 years of expertise in finance, banking, credit, PPP projects, project management, HR, and legal affairs. With a PhD in finance, Dr. Kishore has addressed numerous forums, both within and outside India, sharing insight that reflect his deep industry knowledge. His prolific writing is evidenced by the publication of many articles, and he has played a pivotal role in guiding over 1,000 research projects. So, join me in extending a warm welcome to Dr. Kishore as we eagerly anticipate gaining valuable insights from his wealth of experience and knowledge in today's webinar. So, once again, welcome, sir, and I request you, sir, to please proceed.
Thank you, Rajesh ji. My thanks to Rajnish ji, Devanshi ji, and the entire team at Spark. Firstly, let me congratulate you for being part of such a nice incubation program and the series of the programs what are being held by Spark are the much needed topics for the startup founders like you. And I'm sure each of these topics will help you in further refining, nurturing your startups and in achieving good valuations and success for your venture and for the economy as well. With that brief intro and with my sincere thanks, let me start. So, a brief disclaimer, not much to read. I'll add Spark logo also into this now that I am made an active member into our incubation program. Fine. This is a slide which explains us the worth of a business is measured not by the cost, not by the investment we make into it, but what we can take out of the business. That's a true value of the business, which is what all of you must be trying so that you will achieve the successful valuation for your venture. We are jumping directly into the topic. We have hardly 1 hour time. So why should the startups look at valuation? Is a business is a business run only for valuation? May not be. Does business need only valuation? May not be. But can a business avoid valuation? Cannot. Therefore, valuation for a business is as important as the business itself. And why should startups look at the valuation aspect? In fact, after you start your business with bootstrapped, very wafer thin capital out of your own pocket from your farm, family, friends, and family, the next step of your successful journey is need of funds. If you need funds in a positive manner, it does mean you are walking towards the success. Valuation sets the trajectory to the next funding. How do you raise next level of funding for your growth, for your expansion, for your success? Only when there is a valuation in the previous round, in the previous financing aspect, will you be able to show what is the worth of the business in the coming days, which will help the valuation for the business and the funds to be raised for the business. Unless you resort to an exercise in the name of valuation, the ecosystem tends to miss on the key risks of the business and how to mitigate those risks. Therefore, it's very important that valuation will identify and will mitigate these risks. If there is no valuation, we may not try to understand the risks, we may not try to mitigate the risks also. And only when you agree upon a valuation for now and for the future, will you have some targets putting pressure on you, driving you, forcing you, and guiding you to achieve them in the scheduled periods. And your decisions are bound by the valuation. You will try to achieve the targeted valuation, and every decision of yours will be driven keeping in mind of the valuation of your business. While there could be a shade of negative aspect in this statement, in this point, it has got more positive points. What is it? If a business commands sustainable valuation, it means it's a successful business, it's doing good, helping itself and the ecosystem. If valuation drives your decisions, the decisions also will be right and towards success for the venture and for the ecosystem. And if you don't have valuation, it could be a sweatshop, it could be a run of the mill activity where you do the activity on a day in and day out basis without a target, without an objective, or without a broader plan. It is the valuation which will build this broader plan. Suddenly, as you get exposed to an angel investor like me, or a private equity firm, or let's say a venture capital, you'll be surprised to listen and answer so many questions. Sometimes, as a startup founder, you could be vexed and could resolve that I'll not take any funding, I'll run on my own. The chances of success of a venture that requires funding from outside are 99.999% versus the chances of a successful venture which would not raise external funding, which means a startup cannot run on its own sustainably unless it raises funds. To raise fund, you need the valuation exercise. Yeah. And why is it critical? We understood why valuation is relevant for the business, for the growth. And why is it critical? It's critical because it is estimating the present value of the firm on which the equity has to be allotted and which has to be repaid, has to be shown an exit with future value of company, which means there are three aspects triangularly embedded into the valuation exercise. It decides the success, the sustenance, and even the exit of the investors into the company. It helps in raising the required capital stage wise. If you don't get the funds on time, the business could be at risk. In fact, why only a startup? Any company, when it becomes illiquid with its funds, it is near insolvent. And from that stage, it will move towards insolvency only, which means liquidity is very important. What does liquidity mean? Receipt of funds timely as they are required. That is possible only when we could raise stage-wise capital for the business. And it is valuation what helps whether we could raise the capital as per the stage-wise growth or the progress of the business or not. And proper valuation will only distribute the equity between investors and promoters and other stakeholders like employees, etc., in a fair manner. If only valuation is not fair, the distribution is unfair, and one of the stakeholders only would gain at the cost of other stakeholders. When there is no equity and fairness in the distribution of equity among the stakeholders, such a venture will not sustain beyond short term, and not to speak about the long term. Valuation evaluates the capital structure. It may come as a surprise to you, dear startup founders. In my experience, I have found many, and I would say most, of the startup ventures understanding what is the criticality of the capital structure. They would heard capital and structure as different words and together as well, without understanding what is the essence of capital structure. When you look at the cap table of your firm and understand how the equity is divided, how the capital structure should be properly nurtured to invite capital from not only persons like me, angel investors, but also from venture capital and thereafter private equity, will you understand what is the criticality in the capital structure? It is not just equity and debt. Equity, share capital, and debt are not the only two things. There are multiple variants within this equity and debt also that could be understood when you engage with a dialogue on the capital structure, valuation, company's growth, business plan, what is the equity to be diluted to the investors, etc. It is very, very critical. We'll definitely have more discussion in the days to come, but this should give you the hinting point to pay attention to your capital structure as well. And when your firm is valued in a fair manner, the industry at large takes note of it. Employees will feel proud of it, and you will feel confident. The set of these positive aspects help you in attracting better talent to your company. Better talent, better performance, earlier success, higher valuation, and more benefits to the ecosystem and for yourself. You would become unicorns, unicorn, all of these things. Valuation helps the growth of the company without compromising firm's value. Means if you don't have valuation and you don't have funding coming in, you will operate at a lower scale and may have to continue operating at the lower scale only because you can't expand because you don't have capital. That issue, the positive issue, is positively addressed by the valuation. And valuation is giving the value for your efforts. You've been doing business. It is not the value of all the assets in the company that are sold to get you the value. That is never the value. The value of a business is what it holds as a promise into the future for the investors, for the promoters, for the employees, etc. That creation, the discovery of the true worth of your startup into the future, but estimated today, is only by virtue of the valuation exercise. And if your firm is rightly valued, you command respect. We spoke a while before about this. And as you command respect, as you get more equity, when you get good remuneration for yourself and for your equity investment and for the employees, the performance will be much, much better. Fine. What factors would influence the valuation? We understood what is it, why is it required, why is it critical. These are the factors which will influence the outcome of the valuation and even the starting and the process of valuation as well. They include the founding team's abilities, experience, the proven skills, etc. And what growth has been achieved by your startup. It could be from 0 to 5%, 10%, whatever it is. The growth, what you have achieved and demonstrated, will make all the difference. That would be extrapolated, exponentially extrapolated to understand where the business could go on. Today, just imagine if there is no GPS. Can we think of Rapido, Ola, Uber, all of these things? It's just not possible. If only there is no GPS, what would have happened to this Ola Uber? If only there is no software program, what is used for this Ola Uber? How would all of us would travel? If only there is no ERP for the retail chain stores, how much redundancy and duplication of stocks will be there at every store? Imagine they are not only gaining themselves with these kind of innovations by the growth potential, they are also benefiting the whole of the ecosystem, the whole of the economy, the world at large. So those all things can be shown with exponential projections. And the position in the target market, what is your share today and tomorrow? So if the industry is growing forward, your market share may remain same, may decline, but your absolute business will increase. That can be understood and will be considered while assigning value for your firm. The industry popularity, what you are commanding, there are hardly three players: Ola, Uber, Zugno. There are few more like Blue Smart, Cabbies, and others. But broadly, we remember the top three players because they command huge popularity in the industry. And the intellectual property that you could hold, which could not be duplicated by others, that also assigns a lot of valuation. And what is the criticality? The criticality is how have you raised the funding? In fact, when Devanshi ji suggested this topic, I appreciated her because you have to raise funds at the earliest stage of your life. It doesn't mean before idea stage, it doesn't mean before revenue stage, but as early possible, and if possible, even before idea completion stage also. Because subsequent funding is dependent upon previous funding. The funding is a journey for a startup. As important as the business journey is, subsequent funding may not happen if there is no precedent funding. So even if friends and family or your father, brother, sister who is investing, that should be nurtured, structured, professionally dealt with as a funding round. It could be a mere 10,000 or 1 rupees or even 1 crore rupees. It could be any small amount. Every funding has to be structured as a funding round only. Then the track is built. The revenue model of the business is very key and critical. If you are explaining to me or to any investor about your business, can you understand what I try to understand? I'm trying to understand what is your revenue model. The moment I understand your revenue model, in my frame of mind, I also try to understand whether this business can succeed, can scale up and become big, or will it be one among many, like a run of the mill businesses, which could be like a self employment. Self employment is not a startup, is not an enterprise. So I can understand all of those things by simply understanding revenue model of your business. And of course, the other business credentials. What are other business credentials? So my sister was suggesting that occasionally we should look at the business models, even if I don't invest, evaluate the business of Spark Incubation and guide them how to nurture their businesses. And assuming I send a mail appreciating the way the business is conducted, the credentials that have been built by the startup, and this kind of endorsement is also a good business credential. Let us say one of the big firm, big company writes to you or responds to your mail and engages with you on a dialogue to understand how your business is performing or what is the USP or the service line of your business. And finally, even if that big company is not taking service from you, not investing into your company, still if they are closing it with a true positive line, the customary, ornamentary positive line, true positive line, that is a business credential. So such kind of business credentials also do play a big role.
Sir, I think there is some network issue. Sir, am I audible?
Yes, Rajnish, you are audible. I guess there is a technical issue from Kishore sir's end.
I think he is going to rejoin it.
Yeah, he'll be rejoining 1 second. Uh, जब तक किशोर सर ज्वाइन करते हैं मीनवाइल आई गेस ही इज बैक 1 second.
I'm sorry. I think there
Yes,
is some
yes, sir,
issue.
you are properly audible and properly visible.
Okay, thank you, thank you, thank you.
Yeah.
Fine, thank you, thank you.
Can you please reshare your PPT, sir?
Yeah, should it be? Yeah, I think it is there.
Yeah, yeah, it is here.
Fine, fine. So, okay. So, yeah, I'm on this slide. I wanted to spend some time on this slide because this is very important for us to understand. This is the crux of 60, 70 years of experience of all my seniors and contemporaries, which presents us what are the general funding rounds in private equity. Private equity is a broader term which includes the bootstrapping, seed fund, angel fund, then the venture capital, and finally, of course, the pipe and private equity, everything. This is a broader term, generic word. It includes all the other terms. Generally, you would start your business with bootstrapping. What does that mean? Your own funds out of your own pocket, and also from friends and family, F and F. By when do you want to exit? There is no stipulation. What are the returns you are expecting? Unlimited. Unlimited doesn't mean zero. Unlimited means it could be 10%, 100,000, 10,000, 1 lakh percent. The higher side is not defined. It could be anything. Then what is the exit for you? Either from a private equity or a strategic sale or in IPO if everything goes well. Next comes seed fund. Seed funding is generally by persons like me, persons like you, the angel investors who tend to invest into the startups. And they generally look at 3 years exit period, and the returns, what they expect are up to 15%, depending upon the time horizon and the risk of the investment. Then comes seed A. Seed A is meant for operational growth. Operational growth. Until now, you operated with one machine, one system, one window, one box. Now you wanted to operate with three windows, three boxes, three machines, or two clients. There's not much of scalability here. It's not about scalability. It's just the operational growth you have demonstrated, and now you want to just do it in a relatively bigger platform. That is operational growth. This could be generally funded by venture capital, and the tenure what they look at for their exit would be 4 years. The return what they would expect is 36%. And what is the exit? Some of the venture capital will generally take out or buy the previous venture capital. Then comes Series B. Series B is for scale. You're running one shop fantastically well, three clients, 10 machines, 20 machines. You are finding it a bit challenging to manage these things, but you understand that there is possibility for scalability and you scale up. So for the scale up exercise, You take funds from the venture capital, the tenure or the horizon for their exit, 5 years, they expect 24% now because it has already crossed the milestone of operational success. And what you're doing is duplicating. Let us simply understand one shop in one location became a super success. You are starting two more shops in two more locations. They also will become super success because it is just duplication and scalability. And then Series C for new products and new areas altogether. This is again slightly risky, but slightly risky. Therefore, the tenure of exit is 6 years, but the returns are expected lower as you have proven yourself as a business, as a successful entrepreneur, startup founder, and you are entering into new products to duplicate your successful journey in few products, few areas. Areas is solution areas, not necessarily geographical areas. It could be geographical areas also, but generally the new service areas, solution areas, product areas like that. Then Series D for future expansion. This is for future expansion. Now itself you are aggressively planning, proactively investing, and then scaling up the setup, scaling up the setup of your team, setup of your business, the networks, the collaborations, the tie-ups, the MOUs, and the technology, etc. This is again a bit risky, still safer. For this, you expect private equity, which means the moment we say private equity and not venture capital, although private equity is a generic term which includes all the investment terms, when we practically say private equity, it crossed the venture capital riskier phase. It became a safer enterprise and commanding lower returns only and better prospects, better returns for the founders. For the investors, low return. Therefore, 15% is good enough for private equity investors when it is Series D. Series E is again a bit riskier. You would see the expected return for the private equity in Series E is higher, greater than 15%. It's 18%. Why? Your expansion, what is until now in a consolidated, in a controlled, in a mode of understanding, suddenly now is accelerated. You are taking funds to accelerate your expansion, which is a bit riskier path. Riskier path. Therefore, the private equity will expect higher return than the previous round. Series F. Series F again, you are now not only accelerating your expansion, you are trying to become an institution and you are expecting investments from institutions. It is slightly riskier than previous. Why are you doing this? You want to demonstrate yourself as a company which is on par with the existing listed entities. And you are competing with listed entities which are matured, saturated, and stabilized, institutionalized, have got very lower cost of capital, and have got huge brand image, wide experience, wide presence, good talent. Therefore, the funds what you're investing for this institutionalization will be funded by institutions like, let's say, Blackstone, Brookfield, or Kaplan, or maybe Sequoia, one of these institutions. And they expect shorter return, 3 years return. Riskier phase, 24% return. Then you are just near IPO. What we have seen in Byju's, in Zomato, in Paytm, they mobilize high cost funding during the bridge funding period because they are short of IPO time. They need funds for the 6 months, for the 1 year, for the 2 years, they need some funds. Then it is further riskier, but higher return for the investors. And it is an exit period between 6 to 2 years only, 6 months to 2 years only. This is all as our private equity rounds. For some reason, if things are not going properly, there could be something like WeWork US stage or some other couple of other firms which we have seen. That should not happen to us, but that would be a stress funding rounds where hedge funds will enter, like Blackstone has entered Gokaldas and resurrected. That's a success story, though. Not every company could see that kind of growth story or the reversal. But in this round, generally, merger, takeover, asset purchase, patents, stripping, and then dissecting, all this will happen. Now we move on to the actual valuation methods. Okay, I think they got slightly disturbed in terms of alignment, but we can go ahead. Venture capital method. I will demonstrate what it means when we move on. There are 10 top popular methods. We discuss 5 methods for our understanding, which will be good enough. And
Yeah.
I'll go one after other by virtue of a small workings. Okay. This is venture capital method. All the startup enterprises, if they are holding your calculator, pen, paper, you can also work out your mode now. So this is a startup funded by persons like you. They pooled friends and family round money. They've invested 45 lakhs and they're expecting, they have been successful during the past 2 years, 3 years. They've already proven and they're expecting 12 crores profit by fourth year. To achieve this 12 crores profit by fourth year, there is some investment required right now, which is estimated at 2 crore rupees. And they are okay to give you the exit by fourth year. If you invest 2 crores, they give you by fourth year the exit, and you will you will share the profit by the time in terms of valuation, and the profit expected by fourth year ending is 12 crores. What is the return venture capital is expecting here? 20%. We still call venture capital. When do we call venture capital? When it is still riskier phase. So the value of investment by fourth year is 4.15%. The value, how is it 4.15? They're investing now 2 crores. The 2 crores should grow at the rate of 20% year on year. Then by fourth year, it will become 4.15 crores, which means venture capital is willing to come and put 2 crores now, exit fourth year, receive 20% return, which is equivalent to 4.15 crores. To give 4.15 crores to them, the value of your firm by the fourth year is 216 crores. How is this 216 crores? This is achieved or computed with the industry multiple on the profits. So the industry multiple is 18 times the profit by whenever it happens. So fourth year, 12 crores profit into fourth year 18 multiple is equal to 216. So fourth year ending, your startup value will be 216 crores. What is the value of the investor who is investing now by fourth year ending? In fourth year, the investor's value will be 4.15 crores, which is part of the startup's value of 216 crores. So what we do now is both fourth year valuations, their required value 4.15 crores, your expected value 216 crores. So 4.15 by 216 crores is 1.92%. Therefore, now we give them 1.92% in our company for the 2 crore rupees what they are investing. Then the present money what we have already invested, which is 45 lakhs, plus the money what we are receiving and investing, 2 crores. The total investment in the company is 2.45 crores at the moment. What is the post money valuation of our firm? 104.17. How did you get this? How did you get this? What are you getting? 2 crores. How much are you giving? 1.92%. So 2 crores divided by 1.92 is equal to 104.17. So 104.17, which is post money valuation, is constructed this way. And once from this post money valuation, you subtract the investment what is coming in, which is 2 crores. The pre-money valuation is 102.17. This is how the valuation is made. Now, have a quick look at this. What did you invest until now? 45 lakhs. What is your startup value today? 102.17 crores. It looks so magical. There is no mathematical connect between these two. The connect is by virtue of value into your business, which is coming solely because of the valuation exercise, which factors in the expected possible profit by fourth year, the required investment presently 2 crores, the industry multiple, which is already happening in the industry 18 times. With all this set on one side, honoring the expectation of the investor to give it 20% return, showing exit, the possibility of showing exit by the fourth year of 4.15 crores, and creating value for the firm of 216 crores. These all are possible only because of the valuation exercise. This is VC method or venture capital method. This method is very widely used. The other method being DCF, but this method is very, very widely used. Is it 50%, 60%, 70%? I'm not sure, but certainly it is in those percent terms only, which means it's much more in reality that venture capital method is used. The next method, equally respected, proven, although relatively less used, is Berker's method. In the Berker's method, what you do is you find there are 5 factors universally adopted for all the businesses, and you are trying to assign some factor as a general range between 0 to zero point 0.5 million as per the factor what you have identified, and you will multiply with a specific value for your company, which means now if the idea of the business is solid, you will have to give 500,000 valuation. If the management quality is also quite experienced, proven, committed, and they are well knit as a team, another 5 million valuation. I take a pass. Whichever startup is present in our wide audience, if it has a team and not one person, it has more than one person, I give more marks. And if the team is cohesive, has got good camaraderie, good understanding, sharing of skills, supplementing and complementing abilities, understanding, unified decision, well debated, disputed, but unified decision, I give 500,000 valuation. Because the success of a business is equally dependent upon the strength of the management and the cohesiveness of the management as much as other things, including product strength, market potential, and support by the other stakeholders, etc. Then you have already run past the prototype. You have proven pilot run, couple of demonstrations, etc. Few are already running it and are satisfied. They are okay to adopt this technology. You pass alpha, beta, just about to completely pass beta, then another 500,000. You got few marketing types, although you may not be getting the revenue stream right away. The marketing types do help you for the future. Let us say one of our startups, which is also present in our state, in Madhya Pradesh, Hyderabad, and other places, received some inquiries from big companies for the technology what they have adopted. And the companies are so keen to pay for the travel, for the stay, and to defray some more expenses, token honorarium for the startup. Because those big companies trusted that if this technology works well, we can reduce the cost in our company. That kind of marketing, pre-marketing time itself is an enormous milestone or the factor which would receive half a million valuation. Then your product is rolled out. You crossed beta stage. You already rolled out, and you want to now demonstrate more production capabilities. Another half a million. So by Berker's method, if these five factors are met by a startup, it receives 2.5 million valuation. Now, where do we stand? Now let us look at our startup. Now we have taken 1,50,000 as the range. Instead of 5 lakh, we have taken 1,50,000. And assuming we achieved 20% in all these five factors, we have not achieved 100%, we achieved 20%. So 20% into each of them we get, and we stand at $37,488 or rupees as our value. That is by multiplying these factors with the. So this is possible. This is possible if we achieve part and not 100%. We can look at the Excel sheet also, or I will share the Excel computed worksheet where you can put your numbers and check for yourself. I have already put them into yellow highlight colors so that you don't need to do the formulas, just punch the numbers. Next is the scorecard method. Is scorecard method used? Yes. In cases where engineering, technology, etc. are the core of the business, scorecard method is used. So what does this do? Now, you are taking the comparable firm which is already valued in the industry, and you are comparing seven aspects of that unit and your unit, and understanding if the company has got team strength of 100, what is our team strength on a comparison. That way you're doing. So these are the criteria: scope of your business opportunity, team, technology, competitiveness, marketing and sales, SADM, sales and distribution management, then investment requirements now and in future, and any additional credits, credibilities and features, etc. The weights that you would assign are 0 to 25. So for your startup, you thought business opportunity commands 20% weight. So you gave 20% weight. For your team, for your sector, you thought team matters 25%. So 25% is given. Like this, all these assigned weights are given. Now, if in this sector, business opportunity commands 20% weight, what is the weight? What is the proportionate strength of your firm for scope of business? Are you 20%? No. If you think I'm 75% only, not 100% of 20%, you're putting 75%. If you think I'm 100% of technology, what is available with the benchmarking firm, you will take 100% of 5%. So like this, you are assigning the comparable weights for your startup in comparison with the benchmark valued company. What is the benchmark company's value in our case? 22 lakhs rupees, dollars, euros, whatever. Then for each of these assigned weights for the benchmark company, you are assigning your values. If you see additional features, I put 150%. If your firm has some additional features than the benchmark company itself has, you are assigning more than 100%. Now, the multiplication of 20 into 75, 25 into 80, 5 into 100, 5 into 100, 5 into 85, these give you the weighted factors of each criteria. The sum of these factors of the criteria is 54.65. 54.65 multiplied by the value of the benchmark firm, which is 22 lakhs, is value of your firm, which is 12 lakhs 2,300. That is how valuation of our firm is derived in comparison with the base firm's value. Scorecard method, Berkus method, VC method, all three are popularly used. We need to understand in a better way. Then, risk factor summation. When you can't adopt any direct valuation methods, and when the technology is changing so rapidly, could be week, in a fortnight, in a month, then you will not be able to utilize the other standard valuation methods. In such case, you are not going from the strengths, you are going from the threats and risks. In this case also, you will take the base value of a comparable firm. Here I took 31 lakhs 50,000, something like that, just like that. And for each factor, you thought the value is accumulating, contributed at 2 lakh 50,000. Now you are assigning rating starting from -2 to +2 to each of these 12 risk factors, and you are adding or subtracting the sum of the risk weighted factors to the base value. Let us see in this example management risk. You did not give any risk because you thought your management is good, yourself and your team. So you gave positive 2. So 2 positive into 2 lakh 50,000. 5 lakhs is the value which will be added to this 31 lakhs 50,000. Then stage of business. Your stage is at a lesser progress, lesser pace than this comparable firm. So you gave -1, not very less, but less. -1, 2 lakh 50,000 negative. -1 into 2 lakh 50,000. Then political risk means whenever there is a change in the policy making of the government, not the political party. Political risk means the government's policy changing from EV to diesel to petrol to, let us say, gas, whatever. Some of these policy changes. One, you thought if there is a policy change, it will better your prospects. It will not mar your prospects, but will better your prospects. So you gave positive 1, means addition. Supply chain risk, you are neutral. No addition, no means whatever changes, your business will not gain, will not lose. So 0. Similarly, these factors. Then the sum of all these factors is negative 2 lakh 50,000. Let us say reputation risk. You don't have reputation. Let us say you don't have reputation, or touch wood, you have past history of starting your venture but could not succeed, abandoned it, you suffered, your investors suffered. Therefore, today you have got a challenge of disproving your past, explaining that such kind of past will not repeat because my present venture is good, my team is good, idea is good, I'm doing good. But there is a discount of 5 lakh rupees here, or $5, whatever, 5 million, $500,000 or rupees, whatever, because there is some reputation risk on your startup. So 31 lakh 50,000 base value, which is nothing but the value of a comparable firm adjusted with the sum of all risk factors, which is -2 lakh 50,000, is value of target 29 lakh rupees, which is yours. It could be 50 lakhs also. It is not that your value will be down. It will be much better also, depending upon addition or subtraction coming from these weighted criteria risk factors with the rating multiplications. Then last in my 5 list, the list, and the most important thing, DCF as a method is not used when you don't have revenues. When you don't have revenues, what do you use? You can use risk factor summation method.
Risk
When you don't
factor.
have
Yes.
revenues, you can use scorecard method also. And you can use even Berkus method also. You may not be able to use VC method fully, but VC method also can be used even when you don't have revenues. But those methods will give you lesser valuation than DCF method. DCF is the darling of valuation process because discounted cash flow method will discover the true value of the firm. But to deserve application of DCF method for your business, you should already have revenues. You may not have profits now, but you should have revenues. Once you have revenues and into your projected period, if you can project that profits also will be received, then DCF is a right method. Let us quickly have a look at this computation. 6 years, generally DCF is applied for 5 to 8 years period. Less than 5, unwise. Less than 8, foolhardy means reckless way. Not unwise, foolhardy, reckless. So it has to be between 5 to 8 years period only. Now, in this firm, assuming one of our startups of our thousands of members who are participating now, assuming one unit is now one startup has got 15,000 units of sale and sale price to 60. First year expense is 140 and the investor is expecting only 15% return. That is a discount. Why only 15%? You are in the revenue traction. You are with the profit traction. It is not venture capital. It is private equity what we are talking about because you are now in a safer zone and units would grow year on year at 15%. That is the projection expected. Expenses will grow at 3% year after year. Sales price also will grow at 3% year after year because you have adopted a penetration pricing methodology or initially premium and then scaling up the price as the business grows. One of these pricing strategies is adopted by you. You have 50 lakh rupees worth assets invested into the company, which was supported by your funding and seed funding or angel funding, etc. The depreciation on these assets is for 20 years, therefore 5%. Tax rate, statutory rate, 25%. Now, 6 years, sales are multiplied with these numbers. Expense for 140 and then multiplied. Depreciation, 5% of 50 lakhs coming here. Profit before tax, sales minus expenses minus depreciation. Tax on profit before tax, PBT minus tax is profit after tax. Profit after tax plus depreciation, which is non-cash expense, is your cash flows after taxes. What is the discounting factor? The required return by the private equity investor, not venture capital, private equity investor is 15%. So 1 by 1 plus 1 5, the PV factor, present value factor, are these things. Cash flows after taxes multiplied with PV factor or the present value of future cash flows. Then from sixth year, we are expecting the business will continue to grow at the 3% rate. Therefore, we computed terminal value. This minus 15 by minus 3, this amount. Total company value now is a shade lower than 2 crores. 1 crore 93 lakhs 95,776. Assuming there is no debt, assuming or adopting number of shares in your business are 12 lakhs, the per share value of the company is 1 lakh 93 95 776 divided by 7 lakh shares. So per share value of the company is now 27.71. That is the valuation thing. Now, while I'm done with this, should you require, I can present the Excel sheet to show you how we can calculate this part.
Definitely, sir.
I don't know if I can work out this Excel sheet also. Okay. Any questions are welcome.
Yes, sir. There are some questions in stand box. We
Fine,
have a
sir. Then
startup. Okay, sir. So our startup is asking that how can we estimate the future revenue and cash flow from our startup?
the future revenue from your startup needs to be projected. How do you project? By looking at what is the future sales that you do, what is the sales volume you are going to achieve, multiplied by the sale price what you do. Now, assuming he's talking about a SaaS company, he expects, and let us say Madhya Pradesh is belt of sugar industry. Let us understand, he has devised an instrument or a solution, software solution, which can estimate the humidity or the juicy factor of the sugarcane. He thinks there are 10,000 sugarcane business units in my state. I can sell my solution to at least 2,000 units in the state, which means I am expecting 20% market share. How did I expect? There is no one with similar solution. Once they see my solution, it becomes inevitable for them to adopt. Third, once they adopt, few of them, others could also adopt. It may go up to 5,000, 7,000 units also, but I'm being conservative and thinking that at least 20% of the market share could be mine. And assuming two more units would come up like me, offering similar or other solutions, they will not lower me down in market share, and my market share will be 20% or more. This is how you have computed your market share, and the per unit software sale price is understood by you, and then you have computed the 20% market share, 10,000 sugarcane businesses in Madhya Pradesh multiplied by 20%, which is 2,000 units. 2,000 units into per unit sale price, 100, 2 lakh rupees per month into 12 months, 24 lakhs. So 24 lakhs is the revenue for you in the first year. Now, will you have the flexibility to raise the price, to estimate more number of clients in the future, or expand into other states like Uttar Pradesh, Andhra Pradesh, Telangana, and Maharashtra, Gujarat, Punjab, where also sugarcane is a very dominant crop, where you can expand? Then if you expand into six, like into two, into three, that is how you will expect the revenue stream to go up. And expenses also will have inflationary impact, and your other expense also, your SADM, sales and distribution channel, needs to sustain. Your general expenses will be given a bit of inflation factor. Then you will estimate, these are my projected revenues. That is how the revenues are projected.
Yes, sir. So I think many startup got the idea of understanding startup valuation now, and we have so many questions, but as we are running out of time now, so I think
Dubeji,
I would.
what I suggest
Yes,
is,
sir.
I will commit and answer all those questions. You can mail me and we can mail
Okay,
them to
sir.
our participants. Also, I will share with you the Excel sheet in which these are computed, and I have created like a package. So they can try and understand where do they stand in terms of their startup valuation. Later, we can have one-to-one session with them directly as a part of our Spark mentoring exercise, which we have been doing.
Definitely, sir. So, sir, thank you once again, and for sharing the knowledge and experience. Thank you so much, sir.
Thank you to you, and thank you to Devanshi, and to all the team members at Spark, and congratulations to all the startups who have joined in hundreds of members into our program and continuing to join in the future as well.